Welcome everyone. I'm Lee Harris from Emoji Trading. Welcome to today's webinar. I'm joined by Anthony Drager from the Edge Trading Group, and we're running today's webinar to introduce Edge Zones, which we've just launched this week for NinjaTrader. And it's pretty exciting. We've had a lot of demand for this indicator. It's been available on Sierra Chart for a while, but NinjaTrader users have been asking, and really delighted to be able to share the news that it's available today. And what I'm going to do with Anthony is we're going to go through what edge zones are, and Anthony's going to talk about the importance of visualizing real-time supply and demand and support and resistance. And then once he's gone through that, I'm going to be going into a bit more detail on the mechanics behind edge zones, how you can really work with the visualizations that the edge zones tool provides you with. And then of course, we'll open up to some Q&A, and you can ask us anything about edge zones. And Anthony and I will, chat around the questions that you're asking from our joint experience in this regard. So it should be an interesting and fun session. Anthony and I collaborate on this kind of thing quite a lot. So what I'm going to do is pass the screen over to Anthony, and for the next few minutes, he's going to give you his take as the organizer of a real-time live trading room on the importance of real-time support and resistance and how edge zones help him. So the screen's yours, Anthony.
All right, sounds good. Give me a second. Let me load the screen. Just give me another quick check that you guys could see my logo, Edge Trading Group. Hear my voice. Give me a
all good.
Yes. All good. Thanks, Lee. So in honor of doing it with Lee, I'm drinking tea instead of coffee this morning. For all our UK guys, some guys I recognize in here. I've done this webinar with support resistance a lot, because if you don't know why they work, when they work, it could be the best lines in the world. You're not going to trade them. You're not going to qualify them. All right. And so I always start by going over this picture. If you see my webinars, it's my family. That's me, my father. If you know how, you'll have a job, but if you know why, you'll be the boss. How you'll have a job, why you'll be the boss. And this is the why I want people to focus on. Retail traders, I'm not accusing anybody in here, retail traders. Some are, some aren't. Trade levels, professionals, qualify levels. All right. So yeah, you want to have good levels, and yeah, you want to have higher probability, support resistance, or where markets are going to turn. But without qualification tools, it's going to be difficult to use them. So with edge zones, it's a combination of a good level with the qualification of it. We're going to get into it in my version or my part of this presentation, and then Lee's, and then the Q&A that we're going to open up into. So the why is really important in this. I did a CME sponsored event in New York before all this really hit a few weeks ago. And I had said that 3 people came up to me afterwards. So that really made sense. When I said the why, and that was not this picture. I didn't even show this picture. It was like when kids bother us, when they ask why, right? And if you think about it, it's as a human instinct, a survival, the curiosity that children have. And unfortunately, we ask that question less as we get older and not more. So the why is important. I get made fun of now because this is getting to be a dated picture. It's about 8 years ago, me. And I got to tell you a little bit about me and where I came from, or else it's going to be like, well, some of you guys don't know who I am. So I worked at the Board of Trade, one of the 2 bigger futures exchanges, now all the CME group. I traded there as a pit trader in 1999. I was a clerk at the CME before that. But my trading career started at the Board of Trade as a pit trader. And I couldn't make any money, and I found out there was this building or an office where guys were trading, not with suits, by the way, but they were trading professionally. And I got introduced to it, and they gave you, a workstation, and you split the profits. It was the first 3-year agreement. For 3 years. You get half, and the company gets half. So the savior for me was getting around other people to, again, start answering without even knowing it. Why? Why would this be important? Why would that be important? In the pit environment, I didn't get that. It was lonely, and I was on an island, like a lot of people feel. So, and I tell this story. My father, when I lived at home, I said, if I get this offered the job, should I take it? And I went for an interview, and he says, look, go to the office before these guys leave and look at the cars in the parking lot. If they're making money, take the job. So the owner was the guy doing an interview, and he said, one last question. What makes you think you're going to make money at this? And I said, because I'm putting myself around people that are doing it. And he says, you got the job. He says, it's not just about putting yourself around people doing it, but about putting yourself around people also trying to do it. And that push and pull of not getting overwhelmed and jealous of just people that are doing it, but get involved in the process, in the work, immerse yourself in the process. That word always stuck with me. And he says, you're one of the few people that answered that question right. And to be honest with you, I guessed at it. But it was important to immerse yourself in the process. And so many people don't have a process, right? There's some extra people I was trading around. Some were great and some not so great, by the way. There were guys that got fired. There were guys that were just didn't get it. But it was the best chance at being able to do this. So today, what I'm going to do, and I won't be talking very long, I want to introduce these edge zones, and more importantly, with them being available now on NinjaTrader 8. But I want to go over why they work when they work. Support resistance. One common thing among every trader, whether you're retail or a pro making money or not making money, is levels. They all have them. Wherever you come up, that's the difference. But everybody has support resistance. So you got to know why they work when they work. And with these, they're often just showing stuck traders in real time. So why do they show us stuck traders? And when could they tell you when to pull the trigger and trade? That's two important elements to anything that you're going to look for. Everybody will put levels on their screen before the session starts, and that's great. What updates them? Because the game starts when the market opens. And if you're prepared only for the game before the game, you're going to miss a lot during it. And that's the most important action, to be able to adjust, right? So you think of guys who give commentary on a market before it start or before a game starts, guys who give commentary on the football game or baseball game before it starts. That's great. There's some helpful tips of what to look for. But when the game starts is your ability to say, is what we thought happening or is it not? So we'll talk about real-time edge zone and why they create real-time support resistance, how to qualify in a simple way, how to stay the heck out of the way from certain levels. So how many people will have a level, and let me add this to the presentation. How many people would have a level that they want to buy and it works, but they missed it? It works again, but they missed it. And the third time, I ain't gonna miss it. And it runs right through them. They miss the winner, and they catch it the third time, it's the loser. Common pain point. All right. And you got to be able to understand just because you missed it doesn't mean it didn't work. So you got to keep yourself privy to the context of any level, whether it's our edge zones or something that you have. Did it already work? And how many times did it work? All right. And missing trades, and I got to say this, it wasn't really part of this presentation, but missing trades are so important because they cause you to do something stupid generally when you miss a good trade. They cause you to do something stupid for the next trade. All right. And I don't want people to, I want to minimize the amount of dumb trades, the events trades, the trades outside what your idea is. I want to minimize that, right? Great levels do it. Qualification does it. But I have to say it. I have to tell people missing good trades, you got to be careful and recognize, hey, I missed a good trade there. That's all right. I'm not going to catch everyone. But pay attention to what you do next, because generally what you do next isn't going to be within what you're trying to do. All right. So understand what you miss, understand when levels already worked, so you can understand that, well, Anthony, the more resistant or the more support shows it's working, the more it's going to work. Couldn't be more opposite. Conventional wisdom might say, I think Michael Johnson on X's showing his video. All right, he's up. I think conventional wisdom would show that, or would tell people, hey, this is a good support. The more it works, the less it's going to work. So I guess if there's nothing else you get from this event, the more you see support work, the less it's going to work. And the probabilities diminish. All right. I often use, if you're running into a door that's locked and you're running your shoulder into it, you're loosening up the hinges little by little, right? That's what's happening to support or resistance. The more it works, the less it's going to work. All right. I like to tell stories about metaphors and analogies to give people a sense of what I'm talking about. So I find it helps people the most. Upside down funnel. What does that mean? Well, just stay with me on this. If there are buyers represented by that guy and sellers are represented by cars, and you have a lot of buyers at a particular price, but you have a lot of supply and sellers, what's price going to do? It's going to chop around, right? It's going to be range bound. You guys seen that in chart patterns, right? But once you get, let's say for this example, sellers to leave, but buyers aren't leaving, and the new inventory of sellers might be up there. Now, we don't know it's up there, but what we do know is that buyers are filling in, and all of a sudden, where the neck of this funnel comes, less buyers are able to go through it. So we don't necessarily have to know this dynamic when it's taking place, but we want to know this dynamic when it's taking place. The fact that less buyers are able to get through a particular area to find the new sellers, and this is price discovery, by the way, but we want to put ourselves in the position, if we can't find when it's brewing, okay, no problem. But boy, I want to keep track. I want to keep track on where the market is sped up and where less buyers are able to get through this funnel, the neck. That's where a green edge zone would come, where less buyers are able to buy it because the market moved fast, price moved fast. And how many people, who misses buying it when price moves up? Buyers or sellers? Buyers. Sellers didn't miss it. They could sell it at a better price. Buyers miss it when it moves up. And if it moves up fast, more buyers miss it. This is the why good support is good support. Edge zones is just the visual of this why. That's it. It's simplicity, but it's keeping eye on where did the market speed up to the upside, green, to the downside, red. All right. That's important. Now, if you where'd that car come from? If you haven't heard the baby bird story, I got to tell it. And you've heard it a million times. It's better each time. But this is why they work in any, not just edge zone, guys, but any level you have. It could be a profile level. It could be a moving average. It could be, I don't care. But why do they work? How many people have heard this story, by the way? I have to keep track of this. I think a lot of people have heard this story. It's still good and it's not old. How many people have heard it? Put a yes if you've heard it. All right. So a number of people haven't heard it. All right. Bob, you've heard it twice. All right. So baby bird story is important for any level. This is why it would work. Why support works when it works. First of all, baby birds are helpless. And a lot of traders are helpless. Not anybody in this webinar today or anybody listening on recording, maybe some, I'm not saying all, but many traders become helpless when they don't know important information. Mommy bird in this story is price. All right. She's going to feed the birds. Price is going to feed our order. We're trying to maybe buy it. All right. Just as price gets to us, a hawk comes by and pulls mommy's head off and takes her away. And the hawk could be professional traders, people more aware of what's going on. Pulls price away. And the birds are left with no fill. They drop to the ground and a car runs over them. And that's indicative of maybe blowing your account up. Now let me go over this. and I don't want to show a chart. I want people to understand this is why support would work. If these baby birds are buyers to cover a short position, and they're finally going to get filled, and then the market rallies right from where they wanted to get filled to cover a short position, they now are part of the reason why the market bounces. If there's a lot of baby birds trying to cover a short, that's why support works. Or just trying to buy it. Know this, and I got to say it, I'm not being condescending, but when anybody's short in this business, you are now a buyer. All right? I don't care if you're going to buy it in an hour or in a day. When you're short, you're a buyer. Short buyer, short buyer. So if there's a lot of stuck shorts in a particular area, and there's a lot of people who have to buy it. That's when support would work, guys. That's when support is why support works. You get the baby birds underneath it that are all trying to pray, I'll never get short again and take all that heat. Just let me get out. Screw it. Let me just buy it. And then they reach and then they reach and they jump and they jump. And that's the dynamic of why support would work when it works, and the dynamic of a market that rallies. And Brent says, what a sweet story. And he's kidding. And this is what's good about that is you have to have some edge, that's what trading is. It's cutthroat. It's cutthroat. So nature is. So we're not here to be like, where does the money come from when I make it? Someone, who cares? It comes from people who aren't prepared. So you got to be the hawk, not the baby birds that are helpless. Once in a while, you're going to be the baby birds. I am. We all are. You minimize it. But I want you to remember this story. When you think about support, the support works because buyers are maybe stuck and they have to buy it, but they're all accumulating down there trying. And usually stuck shorts are emotional buyers. What do I mean by stuck shorts? Let me just cover this. If a bunch of people are short and the market rallied and there's enough people short, and in a particular area they wish they bought it to get out was this area, then that's where all the baby birds are accumulating. How do you know they're stuck? Well, I know a price went up, so I know shorts aren't happy, right? Nobody's happy when you're short and price goes up. Even if you still sold it higher, your profit's diminished. If you sold it down here, you're really mad. But the point is, where price got fast, you could accurately assume the buyers wish they bought it there. The shorts that are trying to cover wish they bought it there. How great life would have been if they would have got out there before taking all the heat up to there. So when price starts to come back, mommy bird with the worm, the hawk comes to pull mommy bird right from the nest. And really what that means is you get the buyers down here to say, I'll just buy it, and I'll buy it. And they start chasing it, right? And they start chasing it. So I want people to know support and resistance. In this case, support works for that reason. That dynamic is at play. And I'm a strong advocate. Nobody would ever tell me any way out. You could never talk me out of this. And that is, if you don't understand why price moves in market dynamics, you'll never be successful at trading it because it stays random. So this is important to understand why support would work. So all the edge zones do is show you where there might be this baby bird story playing out. All right. And that's the point of better support than other support. That's all. And this creates probability and creates better visuals that Lee has really been able to make them for Sierra charts, but now NinjaTrader 8. One last slide, then I'll kick it. Punch in the face. What does that mean? Part of what edge zones do is show when buying and selling is quick, right? And so if the market is going down and there's a red edge zone that just pops in, it shows aggressive selling just hit the market. Could be a big order. It could be just a big, quick imbalance. My question and my thought process isn't, oh, they're selling, let's sell it, and everybody is happy. Like the Wizard of Oz, when they're walking down the Emerald City. It doesn't work that way. If selling works, chances are it's already low or too late. Think opposite. If selling comes in and there's absorption and the market is getting punched in the face and it doesn't flinch, if I do that, I run the other way. It's another common story I always tell. If I punch a guy in the face and he doesn't flinch, I'm running the other way. Where does the market get punched in the face? If you have support, then you have selling aggressively at support, and it can't push price lower. The probability to go up is greater. And all of a sudden, your fire and your ready aim fire approach becomes better. It stops becoming a guess and starts becoming a skill. You got support. You got price coming down to support. You got aggressive selling you've identified, which edge zones will do with a flash, a red flash. And the question is now, why isn't price moving lower? Because a lot of selling should make price move lower. I don't care if it's the price of a house or a car or the S&Ps or crude oil or stock. More selling, lower prices. More selling and not lower prices. Someone's defending, and there's more than meets the eye, and you could get the bounce. So when I talk about the why, it's the baby bird story, why support would work and why the edge zones create better visuals. And then the when is the overlap between a decent level, a great level, and then the qualification of that level. And that overlap is where skill is and randomness runs away. The skill of being able to qualify with better support and resistance areas because they actually come up on your screen, not as a matter of math, but as a matter of emotion. When math dictates your support resistance, I'd rather have emotion and stuck shorts showing me support. Fibonacci is great. My joke is, the only thing I like about Fibonacci is that he was Italian. If you're going to use Fibonacci, use it in concert with something else. You got to qualify those levels. So the why and the when is important in this 20 minutes or so that I wanted to spend with you guys. And I'm going to be here the whole time, but the 20 minutes of my presentation or my side of it. And then we'll get a little deeper with Lee and showing some Ninja 8 charts and stuff. But it's important to understand the when and the why to qualify. And like I said, to start my presentation, that retail look for the best levels, professionals look for qualifying. Good levels are obviously, they're important. You want to have non-randomized levels, moving average crosses and all this other stuff. That's great, but I'd rather have emotion for levels, but this is the key, the qualifier. Qualify level, that's good, and you got your qualification is good. Now you're trading. And now you're in front of tools that are going to help you. And one of the things that most people start with is going into a business and not knowing what the right tools are. So you're trying to make money in a business that's tough and competitive, and you don't even have the right tools. So you got to get past what, garbage tools are from the right tool. You got a good saw or a bad saw. It's not even a saw, and you're trying to be a carpenter, and you don't even know that. So you want to put yourself in a position where, hey, I like this tool because it makes me understand real-time support resistance. It creates better visuals and updates to follow and watch order flow. We do a whole series of webinars on order flow and everything else. Keep it simple. Create your own funnel where you start moving your ideas into more of a better, articulate, more detailed way of saying, hey, I'm simple. I used to trade all these different ideas and kind of be random. Then I take a trade over there and I thought I'd be I'll take a shot over here. Nobody could articulate what's in their bucket, what's in their funnel. And then as you get better, you start to narrow those ideas down. And this is your sweet spot. I only take trades in here and qualify them, and I'm in a rhythm. And I think a lot of people have a too wide of a mouth of a funnel or too narrow one where they're trying to qualify too much. And then they have a funnel, they have a bucket. Let's draw a little bucket here. We got time. That's their trades in their bucket of what they're looking to do, and they're always taking trades over here outside their ideas. And then they blame the bucket. Yeah, I've been trading. This strategy sucks. Well, let's look at it. You didn't take one inside the strategy within the idea, and you're blaming it. All right. We're human, so we're not wired to make money at trading because we're not wired to be good at being wrong. We all avoid that. You got to embrace it. I'm wrong a lot. Just ask my wife. All right. So Lee, I think you want to take the screen share back. You could do it and cut this, and then we'll transition to his side of the presentation and then go to a Q&A.
Great. Yeah, thanks, Anthony. So I've taken the screen back. You should be seeing my emoji logo. Okay, that's good. Great. So thanks for that, Anthony. And you used a couple of words that I'm going to major on as well. You know, the importance of qualifying levels, and also you said about having good tools. And what I'm going to show you is the mechanics behind the edge zones. And one thing I like to do with emoji is I really dislike it when you've got vendors of magic indicators who are opaque in their hokey cokey 2000 indicator that identifies dark pools and the institutional trading energy, and this is rubbish. And if you look at the Emoji Trading website, see, we actually explain all of the elements behind order flow. We explain the mechanics of what's going on. We even explain, here's what the indicator is doing, because these aren't indicators, these are tools. There is no magic to reading order flow. You can read order flow from the raw data, and I help people do this. The purpose of using a computer and technology in your trading is to make your life easier, keep your brain free, be more productive, and do the heavy lifting that's hard for you to do as a human. So everything we have at Emoji Trading is really tools put in your toolbox, and unless you understand how a tool works and how to use it, you can't be adept and proficient at using it. So what I'm going to do in the next portion of this webinar is really explain what edge zones are, how you can trade with them, and how you can use the visualizations that they present to qualify the price levels that they're showing. And then you can consider putting these into your toolbox to make you a more effective, more productive trader. So let's get into it. Okay, what are edge zones? On the left, we've got a typical candlestick chart. On the right is a style of chart known as a footprint. And I'm sure that many of you attending today are familiar with the concept of a footprint chart. As a really quick 2-minute recap, footprint charts were invented, probably 15 years ago now, Anthony, I guess, by Market Delta. Smart guy by the name of Trevor Harnett. And what the footprint chart concept did is it showed the volume of contracts that traded on market orders within the candlestick. So instead of just having a candlestick, which gives us 4 data points, open, high, low, close, what we can now see inside the candlestick is the volume of market orders, which are aggressive orders that either lifted the offer, they were buy orders, or hit the bid, they were sell orders. So we can start to get a sense of the strength of trade on each side of the tape. And we can also, by considering a given price quote, let's say, I don't know, we're 23.50, 23.50 and a quarter is the quote. Within that diagonal bid-ask quote, when we look at the volume that either lifted the offer or hit the bid, we can compare diagonally to see who was dominant, who won the battle for a given inside market. And that's a concept known as a bid-ask imbalance. So why is that important? Well, if we look at the footprint, we have got a mass of numbers. And the 3 candles which we're seeing on the right, they're the last 3 candles in the chart on the left. So we can actually see the dynamics of the trading that's going on. And the way I'm doing this is NinjaTrader 8. It's a lifetime license. So it's Ninja's implementation of a footprint chart that they call a volumetric bar. So this is each candle configured to show the volume of market orders lifting the offer and the volume of market orders hitting the bid on the left. Now you'll see that some of the numbers within the candle are highlighted, and I've got some blue numbers here. The way in which this chart's been set up in NinjaTrader is if the volume diagonally is 4 times larger than the opposite side, it's highlighting the volume. So this is called a bid-ask imbalance. So what you can see here is we had 91 contracts lifting the offer versus 19 hitting the bid. 91 divided by 19 is 4 point something, it's about 4.5. So I've said if we've got 4 times or more, 400% imbalance diagonally, highlight it. So we can immediately start to filter and qualify the aggression at each price level within the candlestick by using a footprint chart. But one of the things with a footprint is, it takes up quite a lot of screen space, and we're not really interested in every number. We're interested in patterns within the numbers. So when you get adept at reading the raw numbers, and you maybe use a good tool like this, volumetric bars, then you can see, okay, look, I've got quite a bit of aggression here. I've got aggression over 3 consecutive price levels. Buying stepped in here. Yep, the buying overwhelmed the selling. As we moved through here, we moved up pretty fast. The aggressive buyers probably stripped out the liquidity in the book, which is why we moved up quickly. And we can see the record of what happened. So what Edge Zones does as a tool is it makes it easier to set up conditions in order to highlight when we have got aggression in market orders. So what I've got here in the Edge Zones indicator is I've said, tell me if we have got 400% diagonal bid-ask imbalance, in other words, 4 times as much buying or selling on the dominant side, and I want to know about it if we have got at least 3 price levels adjacent to each other. So now the computer is doing the pattern recognition of looking for this particular pattern within the footprint. I can read it myself from the footprint raw data, but let's have the computer do the heavy lifting of looking for this pattern. And I can put whatever filters I want on here. I can say how many adjacent levels I want. I can say, is there a minimum amount of volume that I want to see on the aggressive side? Maybe I'm only interested if at least 100 contracts lift the offer. I can also say, what's the minimum delta, the minimum difference diagonally? Do I want there to be at least 50 contracts more bought than sold? So I can really start to tighten up my criteria for these events of buyer or seller aggression that I want the computer to identify. So that's what the Edge Zones tool is doing. It's working to your selected criteria to make it easy to highlight when we've got aggression happening. And you could do something as simple as, highlight a level where it's 10,000 contracts or more. So we don't have to think about these diagonal bid-ask imbalances. You could use this just to highlight exceptional volume. And you can put multiple instances of the indicator on a chart with different criteria, if you so wish. So if we've got the computer doing this heavy lifting of analyzing the numbers within the footprint chart, what that allows us to do is not use a footprint chart. Why don't we stick with, a candlestick chart that's familiar and comfortable to many traders who have come from technical analysis and chart-based trading. And let's have the Edge Zones tool doing the work for us. It's looking for these patterns. So this is the same criteria that I showed on the previous chart within this deck. And what we've got now is the Edge Zones showing us when the aggression steps up on the buying side, the demand, or on the selling side. So what it's doing now is when we have what I like to call an event, a new demand event, or a new supply event, significant demand or supply has entered the market, the edge zone tool is projecting out this price level. But what it's also doing is it's monitoring how we're trading when we revisit that price level. Now here, I've got it configured quite simply, and it's configured such that if we close below an area of new demand, then we'll flip the state around to show that it's demand that's converted to supply. We go from green to red. Likewise, if we've got an area of new supply, aggressive sellers stepped in, we'll keep monitoring it. We can test it, but we'll flip it the other way around once we close above that level. So that gives us some basic ways of trading, knowing that we've got demand or supply in the market. And lots of people who are new to trading the footprint charts, they'll see these imbalances. They'll see red numbers or green numbers in a candle, and they'll think, "Oh, look at all these sellers. I need to join in." But to Anthony's example of the baby birds, which is a new story on me. If you chase something that's happened, you're way too late. By the time you've seen it, and by the time you click your mouse and get to your dome, or hit the ticket, it's happened. So actually, what we want to do as traders is we want to trade the market's reaction to things that have happened. So we can do this in a couple of ways. When we see something like this, we've got new supply that's entered the market, we can now be monitoring this level, thinking, well, this is potentially a good short entry. And we've got a few bites at the cherry here. Not considering the structure of the market here. I'm just thinking, if I want to scalp a point or so, I could be leaning on this level because I know somebody got aggressive here, and I could lean on their aggression when we revisit it to go in the same direction. But the other thing that Anthony said is that these levels, support and resistance levels, supply and demand levels, they don't last forever. And this, if you take nothing else away from today's presentation, please bear that in mind. There are so many sites on the internet and technical analysis books from years back that say things like, the more time a level is tested, the stronger it becomes. And it's crazy. You see this on, you see it on rubbish Forex sites, you see it on broker websites, you see it in Investopedia. This could not be more untrue. It is utter nonsense. The more times that a level is tested, the weaker it becomes. And I like to think of this as like playing Russian roulette, that you put a bullet in the chamber, you spin the barrel, you pull the trigger. If you don't get killed, then on the next pull of the trigger, you're more likely to get killed. There is not infinite supply or demand in the market. If there was, trading would be easy. We'd see a level and we'd just keep trading at it. Realistically, whoever was aggressively short here, at the point we've got back here, they fulfilled their trading objective. Each time we've nibbled away here and we've nibbled away here, we've nibbled away here, we've eroded the forces of supply. The guy who sold here, he's probably exited by now. He doesn't care, and that's why levels break. But a typical technical analysis trader, when they're looking at these levels, they're not even aware of the first time this supply steps in. The second time a level is tested, they've got the potential of drawing their support or resistance line or their trend line. But you need the third point to confirm it. A line between two areas, who knows? So maybe they'll be aggressive and trade it at the third touch, or maybe they'll wait for three. Oh, I've had 3 touches. Now I can feel really secure in this level. So when we get back there, I'm going to trade it. And that's why retail people that rely on technical analysis get wrong-sided. They're late to the game, and they're relying on the nonsense that the more times the level trades, the stronger it becomes. No, the more times the level trades, the weaker it becomes. So we want to be able to spot events in supply and demand early and be able to qualify the reaction to them. And that's what edge zones help you to do. So at a very simple way, if we can see the emergence of these new events, we can look to lean on them, we can test the reaction, or we can think, well, you know what, maybe I can look to trade towards it because I know I've got a potential point in the market where something will happen. I know there's someone up here who cares. I could even trade back towards this because I know someone's there. But we can go smarter than that. And what we're showing on this chart is the new supply and demand coming into the market, and then we're using the fact that price closes above or below it to flip its state. What Edge Zones does uniquely is we can set a mode called dynamic mode using order flow evaluation, and we can actually qualify the quality of the trading each time the level retrades. So what the software is doing now, and let's look at this level here, each time we've got a bar that trades around or through the zone, our tool is reading the nature of the trading. It's considering different order flow concepts like absorption, like exhaustion, like unfinished business, and it's using that to determine the likelihood of this price level continuing to hold or breaking. So here at this level where we've got new supply, this first candle through here, our algorithm told us, you know what, the way this traded gives us a strong likelihood this isn't going to hold. So it turned from a solid red zone, indicating new supply, into a dotted outline. So that tells us the supply has exhausted. We've run out of supply. Sure enough, it breaks. It turns into new demand. The way this candle traded back through that new demand told us it looked secure. So you can see we went to this transparent green outline. And very simply, the more color you see on an edge zone, the stronger, the more secure you can feel in the supply demand that you're seeing. If you're seeing not much color, if it's a dotted outline, you can't rely on that zone. You can expect it to break and potentially even reverse its role. And the way we explain this, and this is all very well documented on the Emoji Trading website, is for all of our indicators, whatever condition we're looking at, when we identify a condition within the order flow, we have either identified new demand or new supply. So we visualize that with a solid zone. Depending upon how we trade through that area, if the order flow tells us it's likely to hold, we call that a state of continuing demand or continuing supply. So you can start to get into trading approaches of saying, okay, I've seen a new level. If I see it continues to hold, I'm happy to trade in the direction that's being implied by that level. But we continue to monitor the quality of trading. And this is really hard to do as a human, even if you're super adept at reading the volume and footprint chart. By the time these 5, 6, 7 bars have progressed, you may have lost track of the fact we had something here. And this is the value of a tool like Edge Zones. You're letting the computer do the analysis through the trading session that you can't do. And this could have happened 4 hours ago. And you're not going to be able to scroll back and do the analysis manually. So once we can see that the nature of the trading implies this level has been exhausted, we can do a few things. Well, we certainly don't want to be long. We can be looking up here for an opportunity to go short. And you know what? This isn't our target. We know we're going to blow through this. Sure enough, it happens. We convert from what was an area of demand into supply, but we keep tracking it. So we go through this kind of 6-state cycle of new demand that can become continuing demand or exhausted demand. It can break and turn into supply, and we keep monitoring it. And you can see we can jump straight from new supply to exhausted supply, or even new demand straight supply. And the computer's doing this work for you. And this now makes it really easy to qualify the quality and the strength of the levels that are being generated by the events in the conditions that we're monitoring for within the order flow. So the anatomy of an edge zone is we're looking inside the data that would be visualized in a footprint chart, and you can specify patterns that indicate aggressive strength, lots of market orders buying, lots of market orders selling. And you've got really fine and precise control as to how you want to filter that. Is it a number of adjacent levels? Is it particular size that's traded on one side? Is it the difference in size between two sides? And you can fine tune this as you wish. But then the super value of this tool is that once you've identified this level, it's going to track that level over time so that you can really refine your tactics around how you're going to trade that level based upon how that level has subsequently traded. So that, in a nutshell, is Edge Zones. We've just released it for NinjaTrader 8. It works on any NinjaTrader 8 license. In the lifetime license, you have a footprint. It's called the volumetric bar type, but you don't need the footprint to use Edge Zones. It will work on NinjaTrader free license or released license. And the software is priced at $49 a month, and it starts the 7-day free trial, so you can get the sense for what this is about. If that's of interest to you, you can visit this URL, emojitrading.com/NinjaTrader/Edge Zones. We also have it available for Sierra Chart. That's been available for a while. There's lots of information on the Emoji Trading website. You can reach us here. And Anthony's trading room, the Edge Trading Group, is here. So what we'll do now is be very happy to open up the session to Q&A. And Anthony and I will, we'll handle this jointly. Whether you've got any questions about the tool, any questions about trading supply and demand or order flow, and let's see what knowledge we can share with the questions you've got.
Lee, could you do me a favor? Go back to your chart that was showing when it's not that one, the one before. There you go. So some guy had asked about 715. Gary had asked, and I'm trying to understand context also with him. At that moment at 715, where finally the resistance breaks and we rally.
Sorry, I'm just trying
That's
to get
right.
it right. I want to highlight this thing. Okay, let me get my spotlight tool here. So it's looking here, yeah?
Yeah, so I mean, Gary, if you could just add context around your question about...
I think Gary must have asked it privately because I'm not seeing his question.
Yeah, I think he did. He sent it to me. So he asks, let me read just as it. How would you get out? How would you know to get out around 715? And I'm assuming to get out of a short, Gary? Might come in through your chat. He says yes. How would you know to get out of a short before the pop at 715?
That's a good question. I mean, you've immediately got a warning sign by the fact that this supply has exhausted up here. So if the basis for your trade, well, you know what? I'm going to turn this around the other way. This candle gave us new supply here. The very next candle at 7 a.m. told us this supply wasn't going to hold. It exhausted. So how on earth did you get short?
How on earth did you get short?
There was nothing here to tell us to get short. Yeah.
Right. Okay. Then that's great. Let's assume you were short from above or for whatever
from above
reason.
here or whatever. Yeah.
Right. How did you qualify an exit?
So yeah, well, this would give me an early warning signal. Yeah. If I've been short, I'm short for whatever reason, somewhere here, way off the chart, and I'm going down here. Well, this is telling me that the supply here, is this the capitulation? Is this the sellers who are late to the party? Here's an early warning sign for me if I'm short from somewhere really favorable up here, that this isn't holding. Yeah. I've got other tools. I could be looking at things like delta or cumulative delta. So on a bar by bar basis, what's the net aggressive buying or selling? There are many ways to qualify when
there might be a turn
to exit. Yeah.
You know what? If you don't mind, could you give me controls of your screen and I could try on here? I think that'd be great. All right. So I think I have controls, and let me go to. All right. Now you guys should be able to see this pen. Do you?
Yeah, we see a yellow circle. Yeah.
Yellow circle. All right. So I would also add and maybe say the same thing a different way, not necessarily a better way, but a different way is, there's always turns in a market. Our job is to anticipate it without getting beat up and looking for a turn all the way down. We're trying to create probabilities to find the best exit if you're short. If you're short bad and down here for whatever reason, so that you can get out here instead of up there. There's a little delay between my voice and the illustration, but that's the key in not just getting out of shorts that are winners, but shorts that are going to be a loser, but keep it small. And so you're not taking heat all the way up to here. You're able to get out. So there's always turns you're trying to anticipate. What I tell people is, how do you know at 7:15, going back to the question, to get out? You have to ask yourself, the question is, what do I not want to see? I don't want to see this breached. I don't even want to see this tested. Why? Because as Lee mentioned, it's been tested and tested and tested. And we both said different ways. The more resistance, for instance, is tested, the less it's going to work. People think the more you take a test, the better chance you have of passing it. That's true in school. But the more a price is able to pass the test of not going up, the better chance it is of failing, and then in this case, rallying more. So it starts with asking yourself the question of what, as a short, what don't you want to see? And at this point, using context with all these other tests, I don't want to see a continued test because it's just the greater probability of a pop if I'm short. And again, if I'm short from up here with a winner, or if I'm stuck in the hole and I'm short from down here, what don't you want to see? And there's a lot of other things. When I say a lot, some other things, for example, like another market that moves, I don't want to see that go up. I don't want to see this stock that's driving the market go up. Those are webinars create a whole nother webinar about that. But in this particular case, you ask yourself, what do you not want to see? Now, Gary adds, and his questions are coming just by way we've done this privately. He says, I would not have sold it when it broke the body of the previous candle, or you would have sold it. And that's fine. Everybody's got their own reasons of maybe selling it. And I think that your ability to, if you don't get out at the lows, and who's gonna always pick a perfect exit to exit down in there, but you still don't want to be short when you really created the failure in here. So you're getting out sooner rather than later to create better locations for your entries, but in this case, your exits. And again, just using this information. Go ahead.
For Gary, the key point here is understanding we are trading the market's reaction to what's traded. We can't be in the right now aligned with the volume that is really moving the market. We are too many dozens, hundreds of milliseconds away to the volume, and our 1 lot or our 5 lot or our 10 lot isn't going to make an impact. So we have to be able to qualify the market's reaction to the important stuff that's gone on. And the beauty of being able to qualify these states, and if we think, I'm just going to see if I can do my spotlight here, I think I can. By being able to understand, have we got new supply, continuing supply, exhausted supply, you can start to get into some very simple approaches. For example, here, if I know there's something above me that's exhausted, I could be down here looking for a long. I could even think, well, I know ultimately this is going to break. And when it breaks, what's it going to do? It's going to convert into an area of demand. So I could be waiting for the break, or I could be setting a buy stop. We can be down here. I could set a buy stop to enter up here because I know the likelihood qualified by order flow of us going through here. And if we go through here, where are we going to go? Well, I've got nothing historically above me here. I know I've got some continuing demands down here. This is back from whenever. But you can start to use the information that's being provided by the qualifications, build up some different trading approaches, rather than trying to catch it as soon as it happens. Catch it as soon as it. Well, people always struggle with their fear of missing out, and they get into trades too early and take heat. And actually, the best trades are those that feel like you're waiting and waiting and waiting, and you're late to the game. But these are actually the trades that tend to work out really well and are the low stress trades because you've had time to really assimilate what's going on and build your plan.
Here's a good question. Any value in running in faster time frames? This is a 5-minute chart, right? So I think that whatever a lot of people are comfortable, I never go in and say, it's crazy to use it on that time frame or this time frame. I use point and figure, and I don't want to get into what point and figure is in this webinar, but that's creating a faster time frame, as Brent has asked the question. So in the 5-minute, you're seeing rotations and and that's fine and that's good. And I like a point and figure. To me, it gives clearer rotations of a market. And in a 4 point and figure is more or less like a 2 minute chart if you're going to compare it to minutes for the ES, that is. And so that answers your question. But yes, I think there is value in running it into smaller time frames. You have to take into account the volatility because you don't want a market to be real noisy. And you have to take into account the product you trade and the volume that it trades. But I like a 4 point and figure without getting into details of point and figure. I look at candles or bars. To me, it's the rotation that's most important. How many rotations, which to me identify how many tests there were to a certain area. And so I think that's a really good question to ask. And Michael's question about replaying any day, I think you come to a room that I have, that's kind of what we do, right? I analyze real time what is happening, what should happen. And when I make an analysis of, let me just give you an example. If I say to people, and I don't think I would because of all these tests, but if I say to people, hey, this should hold, we should have resistance here. I'm not telling you, oh, it didn't hold, but see, it still would have worked. Most importantly, when you're listening to analysis, is where would you be wrong? I'm not going to be saying it's going to still hold up here. I'm wrong way before that. So just for example's sake, if I tell someone that the market should hold here, I'm wrong way before it actually ran. In addition to that, real time, what's happening now type of moments of qualifying these levels as they pop in, but also the fact that, you get a lot of people that I take the opposite of victory laps. I want to talk more about where I'm wrong because that's where there's more value in learning rather than victory laps. See, I told you so. There are guys that are bearish there and they see, I told you so when it's way down there, but what happens in the reality of the heat you would have taken? I'll tell you what happens in the reality. People would have got short there, puked it there, then it wouldn't have went down there. They'd have lost money. So you got to. It's a great question, Michael, but it's and it's in that real time kind of scope or environment. I think that you're asking.
And in fact, your explanation really speaks well to the question raised by Brent about the value of running on faster timeframes. I've got a mantra which I give, and my coaching clients are sick of me saying it, which is all charts are wrong. Whatever time frame, whether we're looking at range or minute or point and figure, it's only an artificial representation of what's actually going on in the market. What happens is the market opens for a session and it closes at the end of the session. Those are our real hard areas. But what a lot of people do is think, the faster my chart is, the closer I am to the action. Yeah, that's true. We're seeing more purity in what's going on. But you have got to trade based upon the context and the time frame that you're looking at. So if you're looking at a 1 minute chart or a 5 minute chart, then in like the action that we've seen here, let's just get my pen. So if you're trading this long here, don't expect to be holding this trade for the next 4 hours. At the point you see this happen and this rotate, the idea after 5, 10, 15 minutes for your trade plan down here, it's finished. So if you had taken this as long as this held, or maybe the open of this candle, and you suddenly see this has changed, you don't hold on to this trade in the hope that, well, you know what, I'm going to allow it to go back down to this area of demand here, and maybe it's going to pop back up through here, because you're going to be sitting at your computer sweating for the next 3 or 4 hours and probably have a losing trade. So you can work on, whatever time frame is comfortable for your approach to trading, but be consistent in your trade plan. And when you choose to exit a trade because conditions have changed, based upon the time frame that you're looking at. And this is what a lot of people get confused by, that they'll zoom in to get really close to the action, but then hope that they can get their trade that's going to last all day and make them many hundreds of thousands of dollars. Be consistent on your time frame and your approach, both to entry and also to exit.
Hey, Lee, what you just said, all charts are wrong, was awesome. I was going to start writing that down on the chart. Is that what you said? Is that how you said it?
All charts are wrong.
Yeah. That's well said.
Copyright Lee Harris 2018.
TM. No, that's it. All charts are wrong. And it's what our job is to predict what's the chart going to look like. And when are we wrong in thinking it's going to look like that? So, no, that's well said.
Now, I see Michael has asked about information for your room. So, yeah, Anthony's room is edgetradinggroup.com. And Anthony, do you want to speak a bit to the commercial approach that you have there for new guys in the room?
Well, the best bet is I used to have trials, and what happens in a trial is, when you're in a new environment, things are moving fast. And so what I did was I do a YouTube video every day, and I think that's your best bet to find out more about what you're going to get is just highlights of the room. And some of the videos are as short as 2 minutes, 5 minutes. They're not very long videos. And in fact, I'll pop in, let me see my channel here to people to go right to that. And I think that's your best bet because I think trials are normally fine, but when it's good information in a particular environment, you're not going to understand everything. You're not supposed to, or there's no value there. You might as well host the room if you understand anything. So then you go in a trial and some people are nice that they don't want to ask questions, and some people should ask questions, and maybe they don't and they do, but things are moving fast. And so it's harder to get a good sense of a trial, so much more in understanding what it is about. And that's where this YouTube channel, I think, has been better than any kind of trial someone could get. So I'm going to pop that in to everyone, the link. And if you subscribe to it or just go and view it, you guys will, I think, get more than you bargained for.
And I think what's important, Michael, when you are assessing whether it's tool vendors or people that run rooms or educators, whether it's group education or one-to-one, you've got to go into any educational room initially open-minded, because you are looking to gain something. You're not going to get a silver bullet. You're not going to suddenly pick up, oh, I see Anthony's method and in one day I understand it, I'm going to clone it. It doesn't happen. Everyone has got a different style and different approach. And you have to be open to assimilating that approach. But what I see some people do is they'll come with their method that works for them, MACD, RSI, this sort of rubbish, and they will look to impose their existing knowledge and belief on how they trade onto the room or the educator that they're coming with, and they're looking for it to be validated. And if you take that approach, it doesn't matter what room or what educator you work with, you're wasting your time. You've got to park what you know and assimilate and absorb some new stuff and see if it gels, see if it resonates for you. So nobody is going to give you a procedural approach of do this, do this, do this, do this, and you're going to get 95% winning trades. But you are going to pick up nuggets and approaches and ideas from educators and rooms and different styles, as long as you remain open to hearing them and absorbing them.
Hey, Lee, what does rubbish mean?
Trash, garbage. Look at that. I can speak English 2.0.
I know what it means. We don't use it as much as you guys, but I'm sure we use stuff you don't.
Alessandro, who's asked, is there a lifetime license for EdgeZones? No, there isn't. The commercial model at Emoji is we provide our tools on a monthly subscription basis. And this is because we continue to develop and update our tools. And in a few months' time, we've got a very interesting update coming, which will apply to EdgeZones as well as many of our other tools, that makes things very adaptive. But the reason we're able to continue ongoing R&D on our tool set is because we run on a subscription model. If I sell you a tool for $20 or $200, or God help us, $2,000, it's a very limiting business model. We also, I will say, we provide excellent support. We've got lots of free, very factual education around order flow on our website. So in order to support this kind of approach, we run on a subscription model.
Hey, one thing I want to add relevant to what's going on in these markets and this volatility, you watch this recording in 3, 5 months might not be as relevant, but it kind of in a way is the volatility trading as long as I have from 2000 and 9/11 and 07, 08 and the Greece and then there was all kinds of volatility. There was massive volatility in February of 08 about inflation. And I think a year before that, at the beginning of the year, China was getting hit. And then throughout 2019, the US-China trade deal. This volatility, because of the coronavirus that's globally really caught the markets, the world, the economy, and people offside, is a different volatility from all the other ones. Yes, it's moving, and yes, the ranges are wide and the volumes are high and the moves are pretty dramatic. It's different, and I've talked to other people who've traded a long time, and they agree and say the same thing. It's different because there isn't as much of it's sometimes a controlled selling in a chop. It's like a dangerous chop. But yeah, you look at the chop and it's 20 handles, 50 handles wide, or the follow through is limited. So if you don't catch that first move, which was a big move, and you look to think it's going to happen again in other volatile markets, it would, and now it doesn't. And now the turns are dangerous. It's different. It's opportunistic, but it's different and it's dangerous. If you've never made money trading prior to this, this isn't the type of market to jump in and think, well, okay, I'm going to make money in this. And I never had any skill or success doing it before this, right? So I think you got to be very careful in this environment. Always careful in volatile environments because your risk automatically goes up. But this has something that's a bit different, and but I just want people to manage the risk. I always say manage your risk before you take it. So know where you're going to be wrong. Ask those questions. If I'm short, where am I wrong? If I'm short, where could I get out and then why? And then you're building the idea and you're building out that progression. And you're not caught off guard and you're not caught by surprise. And you know what moves are coming based on what news might hit. And you're anticipating it so you could react diligently. But you got to remember that everybody has that responsibility to understand the markets that they're trading, manage your risk by reducing your size. And it's a lot of people have done that. A lot of people haven't. I am hearing that from brokers, a lot less people are blowing out than in volatile periods in the past, which is good, which means they're respecting it a little bit more, or a lot more. So
I think if we look at ES, if you look at the size of the limit orders in the book during the day session now, we're in a few dozen contracts, whereas normally we would expect, several hundred at each level. And it's as if the volumes in the book on ES are what we would have seen a few months ago in NQ. And it's like, ES has turned into NQ in its nature of trading. It's become a thinner market. So with that lack of liquidity in the book, someone only has to do a market order for what, 200 lots, and we're going to strip through 4 or 5 levels really quickly. So the characteristics of the market have changed, and when until you adjust to this, or if you're new, the key is you've got to scale back your size, and that's where micros are great at the moment. If you trade E-mini, trade micros, trade 1 or 2 lots of micro, because the swings are going to be wider because of lack of liquidity. And the way you've been used to trading 3 months ago, unless you are really knowledgeable or you're happy to put your capital at risk and you've got a very fat account to insulate you from that, why take that on? The tools are available from the CME.
Right, and they weren't last year at this time. They came out in May of last year with this micro. So the smallest you could trade in the SP minis was a 1 lot. Now it's the micros. And yeah, the commissions, when people say ratio wise they're high, hey, if you're worried about commissions, you're starting off on the wrong path. Yeah, commissions and high commissions are a problem, and you need to lower them and make sure you're in a brokerage that has competitive commissions. But what the micros allow people to do is take the money off the table. You trade the process, you trade the market, and not the money. Everybody says don't trade the money. Very easy to say, very hard to do. The micros make it easier to do. So remember that. Great market, even when this volatility goes away, great market to learn with skin in the game instead of jumping in.
And some of these other markets. The daily ranges have widened as well. So whereas we'd have typically been, what, 20, 25 points on ES, we're at 3 times, 4 times that. So, if you're adept to the micros, you can still, well, through 10 times less risk, you've still probably got a higher earning opportunity when you're taking on more risk using the E-mini. So you've got to adapt. You've got to adapt to your environment as you're a trader. Nothing continues in the same way forever, just like supply and demand levels.
I like Brett's comments about companies that sell their tools. He's right. They spend time making their tools instead of making the developing them and making them better, listening to how customers are using them and how they're using them better, and just being flexible and adjusting. And that's what I could say Lee does.
I appreciate that. Yeah, no, so thank you for posting that, Brent. And actually, this jogs my memory that we are shortly going to be published within the NinjaTrader vendor ecosystem. So, we've met the quality levels in order to be listed as a vendor within this kind of NinjaTrader marketplace. And I was looking at some other order flow indicators, and actually there is no secret source to any order flow indicator. You're looking for certain patterns within the volume, and you're visualizing it and potentially tracking it over time. That's what is happening. And I think what's a little bit different about Emoji is, we're transparent about this. We're not saying this is some magic proprietary algorithm. I've told you in this presentation the condition we're looking for, and actually the value that we bring is that we can track it over time and qualify it, so that you can see the progression of these levels over time. And I was looking at a tool set in similar space that was contending it was uniquely identifying patterns through proprietary algorithms, but these are secret proprietary algorithms. I think the price for this was something like $2,600. Now, trading is all about minimizing your risk. Now, if you buy a piece of software for $2,600, which is a flipping large amount of money, that's an English phrase, you're taking on big risk. And actually, to Brent's points, risk 1 ES point, try our software for a month. In fact, you can try it for a week free of charge. And, if it's utter garbage, or if it doesn't work, or if you don't gel with it, then you've risked 1 ES point. But this is in the context of a vendor who's telling you exactly what it will do and has a bunch of support resources and educational resources behind it. So this is why I don't believe in lifetime licenses. They are high risk for everybody.
Yep. Hey, I think that once maybe you like it, then you inquire about it. That could be different, but it's a good point. I never even thought it through that way. And I know you have, because that's your model and you're a developer. One unique thing about Lee that I've found in this business. Now, I come from the floor, then I'm a prop trader, then I'm independent, and I back into education from a guy that sent guys to me, asked me if I talked to guys that used to tour the Board of Trade back 10, 12 years ago. And then I had a relationship with Market Delta. They knew I used their software, and they had trouble teaching people how to use the footprint. And so I didn't work for them, but I had a relationship where I did a room just a couple hours a day. And it really helped people understand more about what the footprint was about than just a bunch of videos that were out there on it. The point I'm trying to make is that through understanding people on the floor and how that was like, professionals in a prop firm and what that is like, people from all different walks of life trying to learn this business on an educational side, the software industry and what people go through, pushing out charts and making those better, developing things like this. Very few people have the combination of trading and development like Lee does, where most developers are developers. So they'll ask traders questions, or they're pushing stuff out. They really don't understand the market dynamics that I explained at the beginning of this presentation. And so Brett Steenbarger is another guy on the psychology side. He's not just a trading psychologist or a psychiatrist. He understands trading because he trades. That mixture is unique. And I'm telling you guys, from my 25 years in this business, you don't get that combination. And that's where there's a lot of value. Developers are great at developing. Traders are great at trading. When you can bleed them together, now you create more of what we're going through, and the developer knows that. I'll give you just a story of this example. In my days as a prop trader, about 4 years into it, the owner hired a psychiatrist. For free, he would work with the top traders once a week. And I was one of them. And so for free, I got to talk to a psychiatrist once a week for an hour. And I found that I was helping him more than he was helping me. I was helping him understand our business. You know what he said to me? He says, what's fascinating about trading is that you guys are doing directly every day what everybody does without knowing it. We're trading ideas today. We're trading jokes and laughter and unfortunately a virus, and I'm not making light of it. We're trading things all the time. Trading futures, trading stocks, trading price has the similar dynamic of it, meaning risk of what you say based on what's going to come back to you. And that made me think, we're helping this guy more than he's helping us. He didn't help us on a grand scale, and they eventually got rid of him. Then Steenbarger comes around, and here's a guy who understands what we're going through because he goes through it. So really, really important, that overlap of people who know what it's about, go through it, went through it, and all the above. And that's, I think, why, Lee, you've got this model, is because you realize that there's too much. You're understanding risk as you put a price point on it. So I hope that helps people understand, Lee, or anybody who's trying to help you.
And that's true, Anthony. And I'll pull up the screens for 2-3 hours a day. I spent time in a prop firm in London, and I realized for myself that I didn't want to stare. Well, A, I didn't want to wake up at 4 a.m. to get the first train into London. B, staring at a screen for 6-7 hours a day wasn't for me. But I now regard my trading activity as research. I need to watch the markets to look for patterns and setups within the order flow that can be tested and are consistent and potentially productized. So yes, I have a leveraged business interest in the business of trading, but what I find is there's this virtuous circle. By understanding trading, I can produce good tools, but equally the process of researching and developing a tool makes me a better trader because I've really got to get right inside the mechanic of what's going on in the market. So I think for any associated service to an industry or to the industry of trading, whether it's psychology, education, software, you've got to have that understanding of the domain that you're in. So,
well, here, I'm sorry, I thought you were done, but you said charts lie. If he was just a developer, he'd never have that. He would have never had that comment. Like, all charts lie. It would have been impossible to have that comment. And that's the circle. As I draw circles, it's the combination of skill in what you're trying to do. And in trading, it's the level, it's the qualifier, and it's the middle. Hey, the best trade this week for me, came from, there was a little resistance, but it wasn't the resistance that got me short. It was some bad news came out of Lombardy, Italy, and it was the downside was the right side for at least temporary. So it was beginning, or it's understanding how to anticipate. Anticipating what questions to ask when you read order flow, what questions to ask when headlines come down, know how to diligently react. Don't look around after the guy in front of you slams on his brakes. Know to scoot to the other lane because nobody's in your blind spot. You're not ending up in the guy's back seat. You're not making the passengers uncomfortable. You're aware. You're a driver. Be aware. So many people are unaware in this market and risk their money. That's where the money comes from, right? 90%, whatever the high number is, people fail because they throw their money at this thinking that it's easier than it is. You stack probabilities. You become the house instead of the player. We'll talk about casinos. Think of that probability switch between the player and the dealer.
Yeah, if you can procure even just one piece of good information, I very much like showing super clean charts just with one tool on there. We have various other order flow tools, and people will say, which ones should I use? Well, they look for different conditions, but then people will throw 3 or 4 all together without really understanding the mechanics of what's going on, and their chart becomes this cluttered mess. And you can easily build, a consistent way of trading just with one order flow concept, such as aggression, which is what Edge Zones shows you, and build your trading process, which is the word Anthony used very early on. You must have good process to your trading, and just stick to it. Trading is one of these endeavors where less is more, but you need that fundamental understanding of what you're doing and then the self-discipline in order to stick to that plan of what you're doing.
Less is more, but nothing is not more. You got to have something. So
Yeah.
you're right. Less
Something
is
to give
more.
you an edge and just stack the odds slightly in your favor. Yeah.
That's why the name of my business had to have the word edge in it. When I started, that word was synonymous on the floor. It was synonymous in a prop firm. What's the edge you have? And there's other things like you never go broke being, or you never go broke taking profits, and the sayings of just trade with the F word in the middle of it. You know, when people overthought situations, and so but accountability and togetherness or community is important. And when you know what you're talking about, you know when someone else doesn't. And that's where you guys want to get yourself. Some are there, some are getting there, but you want to put yourself in a position where you speak the industry, speak in the industry language, and you put yourself in a position to know the difference between those who know what they're talking about and those who don't. And unfortunately, you're not when you're first introduced to this business. You don't know what you don't know, including me. The first class I took spent $100, and I spent a couple $1,000, and it was worth it in this other class. It was 3 different versions back in 1998, pit trading, and they were well worth it. 3 different steps. And I'm telling you this for a reason, because the first class I took was just $100. It was the worst. It wasn't $100. It was the worst. It was about spread trading. And I wanted to learn about spread trading because I was a clerk in a market that was being spread. The guy was telling me about different spreads he liked. It was boring. He was bad. But you know what? It was invaluable because I was then could compare crap to what's good. There's no such thing as good looking people unless there was ugly people. So you got to have both. And that's what he was bad education, but I knew it was good, not for the price, but the introductory thing to this was like $250, and it was great. It was real trading in a pit. This is before the screens. But again, you don't know what you don't know. Just go with what the whole managed risk approach. You're not spending $2,000 and being wrong. You're spending 50 in a month. 7-day trial is great. If you're on the fence, do it. $50. If you know, it's great, I can't use it, well, then don't do it. But don't do the trial and then be on the fence. Make the decision. That's what traders do. Make decisions knowing where their exits are. So I wish you guys a lot of luck. Do you want to wrap this up, Lee? I don't see any other questions. What are you thinking?
Yeah, I think we've dealt with the questions. If you clear your drawings, Anthony, then we can just that's that. But I don't hear Warner Brothers coming knocking at your door for animation help. So yeah, just to wrap up, Edge Zones is available on NinjaTrader 8. It's $49 a month, the 7-day free trial, and you can find it at the emojitrading.com website. Anthony's room is theedgetradinggroup.com. We will send out an email shortly after this with a link to the recording. Feel free to get in touch with any offline questions you may have. And thank you very much indeed for turning up today. And please all stay well and healthy.